Welcome to our viewers on EBNet Stream. I'm Leon Kralin, and I'm joined today by Rademeyer Vermaak, who is the head of, and I'm going to have to read this, Rademeyer, the Stanlib Systematic Solutions Investment Team. I'd like you to tell me a little bit about yourself, or tell our viewers a little bit about yourself, but please can you explain what is a systematic solutions team?
Hi, Leon, and thanks for the opportunity to chat to you. Looking forward to the discussion. I guess what the word systematic means is taking a rational, pragmatic, and consistent approach to portfolio management. And I guess the best quote from the famous Warren Buffett is probably the best way to articulate that is to invest successfully over a lifetime does not require a stratospheric IQ, unusual business insights, or even inside information. What is needed is a sound intellectual framework for making investment decisions, and then the ability to keep emotions from corroding that framework. And that is what systematic investing is about. So systematic investing starts with humans and with people that design the investment process. And systematic investing ends with humans that implement the portfolio. But the steps in between are all well-defined, fundamentally and rationally sound, and they are designed in such a way that they allow you to have a consistent application of your investment philosophy, so that you don't get your investment framework corroded by emotions, and that when given a certain set of information, because there's so much information in the market and so much of that is changing, that if you were confronted with a set of information 5 years down the line, you make the same decision given the information that you have before you. Does that make sense?
I'm with you so far. I am. Keep going.
So I guess the systematic solutions team within Stanlib started out as one of the equity teams within the business, and we are now managing a broad range of different funds, ranging from some of the index tracking funds through to very active equity strategies.
So if I can then on that, what is the total assets that your team's looking after, and what is the size of your team?
This team is 11 people strong, coming from a wide variety of different backgrounds. We've got engineers, CFAs, MBAs, accountants, mathematicians, BCom investment management, so a wide variety of different skill sets. And we manage about 110 billion in assets at the moment.
So the funds that participates in the SA Equity Manager Watch that Alex Forbes produces is called the SA Equity Composite, and that's around about 5 billion or so. Could you just help me understand why that fund in the survey is it the only one that's appropriate for that survey's sort of categorization? Because as a percentage of your total assets that you're responsible for, it's not that big in that context.
So it is the only fund that is SA only, and that is active. So some of the other assets are index tracking funds as well. The total assets, including seg mandates and allocations on that strategy, is around about 16 to 17 billion.
Okay. And what percentages? Sorry, just to remind me, you said your total AUM for under equity strategies was?
Under equity, well, look, the 111 includes some smaller bond mandates. I'd say probably about 100 total.
And what percentage is passive?
Probably around about 60%.
Okay, and within your systematic strategies, all this the SA Equity Composite, would there be a percentage that you hold within passive as well?
I'm not sure I quite follow the question.
Is it a fully active mandate
Yes.
Or would you actually blend between active and passive?
No, this is fully active, bottom-up stock picking using a systematic approach.
Right, excellent. So I mean, the performance of this fund's been excellent. I mean, the longer term results, ranking third out of 48 over 3 years, and third out of 45 over 5 years. So there's consistency that is coming through. The shorter term numbers looking good as well. Perhaps you can just give us some context of what's driven that performance within the fund. And also, when I have a look at your tracking errors, they tend to be a bit higher than the rest of the market. Is that simply a case of risk equals return if you get it right? And what does that mean for the future? How do you view risk in your management approach?
So let me maybe answer the second question first. We don't target tracking errors specifically. We do have some sophisticated risk management constraints within the portfolio construction. And we can delve into those a bit later, but broadly, we can constrain for active single stock risk, active sector risk, active market beta. So we try to build a portfolio that's got a market beta of 1. And we also constrain, which is, I think, quite unique in the SA market, we also constrain for active macro risk. So let me delve into that maybe a bit more. Every stock in the benchmark has got some exposure to big top-down macro drivers as well as bottom-up fundamentals. Let's take Goldfields, for example. Its share price is obviously driven by its bottom-up fundamentals, but also by the price of gold, which is a big macro driver of the stock's earnings. And so what we do is we measure the sensitivity of every stock in the benchmark to a number of these macro drivers. For example, the oil price, the rand-dollar exchange rate, and the gold price. And that means that the benchmark as a construct is driven by some top-down macros. So if gold counters are 20% of the benchmark and the gold price goes up by 20%, then the benchmark will move up, if everything else stays the same, by a certain amount because of the gold price re-rating. So when we construct a portfolio, we try to match the macro exposure of the fund with that of the benchmark, so that we don't have an active risk to these macro drivers, because those macro drivers are very hard to predict. It's very hard to predict what the rand's going to do. It's very hard to predict what the gold price is going to do. So if we don't want to take a risk in that dimension, we neutralize that risk and we match the benchmark exposure from a macro perspective.
Do you always neutralize those macro positions, or is it when you have concern or uncertainty, or call it lack of confidence in a view around them?
No, we always neutralize those macro risks. And if I can use the example of gold, we would be overweight some gold counters, those of good quality and good growth prospects and with good valuations, and we'd be underweight other gold counters, the ones that are lower quality and with less earnings growth and that are more expensive, so that our net active gold risk is neutral to the benchmark, but we're taking active stock risk on the counters that we prefer.
Okay, all right, good. I wouldn't, there's not the right terminology. It sounds a little bit complex, if I could put it that way, all right, in terms of the process. I know for you that it's not, but for the layman, it probably is a little bit more difficult to understand. How does this translate, this approach that you have then translate into the other product or the other solutions that Stanlib offers? So the likes of the multi-asset funds and so on, do they take the same approach into their carve-outs, their relevant equity carve-out and so on?
So obviously the multi-asset team under Marius manages the balance funds. And Marius will, when he wants to make an allocation to active equity, will allocate internally to some of our team's propositions.
Okay. Taking exactly the same approach, therefore, comes through in terms of their allocating to your propositions.
Yes.
Okay, great. Now, you would therefore say that you have managed risk based on that belief system that you have, yet it's resulting in, relative to others, a higher tracking error. So do you have any comment on that? Is that not important in your mind? Or is it not, rather say, relatively important enough in your mind?
So I guess what we're trying to do is we're trying to maximize alpha whilst trying to minimize the tracking error. But there's always a trade-off between risk and return. And it's one that we are comfortable with.
Okay, but relative to your peers then, because ultimately that's where the trustees and consultants are going to now make a comparison. How do you view that?
So I guess the one thing I will say about the tracking error is that sometimes there are spikes and periods of relative outperformance, underperformance, and that data point sits in your tracking error. So you should also look at not just an ex-post tracking error or backward looking, but also look at an ex-ante. And on an ex-ante basis, we are, I think, much more in line with peers.
So it just shows you the dilemma that trustees have. I mean, to understand all these different measures, the different variances around it or variations around it and so on, don't you think it almost makes it impossible for them to understand things properly? And how do they go about doing that?
I guess that's why and where consultants come in that are able to provide advice around the performance profile of a fund, the correlation of the fund with other fund managers in terms of the diversification of investment process that allows you to unlock a potential free lunch when allocating to a number of different equity managers. And I guess that's also why it's important for fund managers to be able to articulate their process clearly. And I think maybe I went into a bit of heavy technical detail with the macro risk, but I think it shows the sophistication of the risk management. But I want to also maybe talk a little bit about our bottom-up stock picking philosophy, which is, I think, where the alpha gets generated.
Yeah, so I would like to come back to that. I want to talk about where the performances has come from ultimately, but just before we move off from the, call it the trustee or the investor dilemma, it's the self-same consultants who are providing the surveys with the backward-looking analysis, essentially. So I'm not convinced that we all understand these different aspects and what goes into it. And we also tend to sometimes assume that when we speak into a board of trustees who come from varied backgrounds, maybe they're an engineer or whatever they might be, it's not second nature. So we might feel that we need to be clear, but clear is not clear enough, if that makes any sense. And I think sometimes we can be our own worst enemy through what we do put on the table and how we do try to explain things. So I'm putting that. I'm not the one being interviewed, but I'm putting that as a comment on the table. If you would like to retort in any way.
No, I agree with you, Leon. But I think the way that you articulated it is 100% correct.
Okay, well let's move on then to, I mean, the performance has been good, which is great to see, particularly from a house like Stanlib that has been a stalwart in the industry for so many years. So can you perhaps just give some insight into what the performance drivers have been, what has been successful, and maybe also where you believe you've got some things wrong and learned a few lessons?
Sure. So let me maybe just share a presentation with you and talk you through a couple of slides that will lay the foundation for the conversation. Our fundamental investment philosophy, can you see that slide? Okay. Is that we invest at the intersection of quality and value and growth. These are key fundamental drivers of the stock market. And perhaps the way that is more easier to understand in that is that we try to find profitable companies with attractive growth prospects, and we try and buy these at discounted valuations. So we look at that in a Venn diagram. We try and buy stocks in that green flower in the middle, ideally in the pollen in the center of the image, but we also buy into the petals. And then we build a best-in-class risk management framework around that, where we control for liquidity risk, the correlation risk in the portfolio, so how to best blend the stocks together to reduce the risk, and then also that macro risk element that I spoke about. If I elaborate a little bit on this, a stock that is worse than average from a quality perspective, worse than average from a growth prospect perspective, and worse than average from a valuation perspective, so expensive stock, we would call a worst-in-class stock. If a stock is purely cheap, but it's low quality and with no growth, it's a potential value trap. If a stock is of high quality, but it's expensive and with no growth, it's a potential quality trap. And then if a stock has got a lot of growth potential, but it's expensive and with low quality, we call that a potential growth trap. In the middle, the petals is the best in class, a stock that is simultaneously of high quality, good growth prospects, and with good valuation. And then at the petals, a stock that is of high quality and with good growth prospects but expensive, we call that quality at any price stock. A stock that is of high quality and cheap but with no growth, and the market isn't yet realizing the movement or the potential, that's a contrarian stock. And then a stock that is of good growth prospects and cheap, but of low quality, that's a stock that is in need of some restructuring. Now, what's interesting, and within this framework, we can now go back in time to 2002, and looking at the fundamentals of every stock in the market, we can classify every stock into one of these buckets. And then we can see what the performance of each of these buckets were through time. And this is the growth of R1 that was invested in the benchmark and the various petals. So to give some context, this line in the middle, the red line here, is the performance of the capped Swix. And you can see how the best in class, this excludes transaction costs, so this is purely for information purposes. The best in class stocks significantly outperformed, and the second best performer is quality at any price. So South African market definitely has an appetite and a preference for high quality companies. The third is stocks that are restructuring. Down here at the bottom is value traps. And I think we see that in the SA market. Value and value fund managers typically tended to struggle, have high volatility in their performance, have short periods of sharp outperformance, but over the long term, the value trap investment style, or the value investment style, has certainly struggled. And so what we're trying to do is we try and buy stocks in the pollen, the best in class stocks, and then stocks in the petals, contrarians, restructuring, and quality at any price. And this is basically, if we do that consistently through time, having identified these main drivers of return in the SA market, return on equity, price earnings multiple, earnings momentum, growth momentum, there are a number of different alpha signals that we look at. And then we just keep buying stocks within the flower, and we build a robust risk management framework around that. That is what has been generating our outperformance. And so if you look at our portfolio, our biggest overweight, Life Healthcare, currently sits in the best-in-class category. AVI, Clicks, and Mr. Price sitting at the quality at any price petal. British American Tobacco and Absa in the contrarian. Those are our biggest underweights in red. Harmony is in restructuring. And then in the value traps, it's FirstRand, and worst in class is Anglos and MTN. And so, in essence, that's what we do. We consistently and systematically look at the fundamentals, and we keep buying stocks in the petal.
So in that context, your classification of the stocks into call it the different buckets, if I may, is going to be dependent. Is it an arithmetic process, or is there also a human overlay in terms of understanding the company, future prospects, and so on?
So the process starts with humans. So we download the fundamentals and the market dynamics for every stock in the SA market. And we then start processing that information. You obviously need quite a holistic framework, and it's a very data-intensive exercise, which is where the engineering skills within the team are put to good use. But the data we look at is both backward-looking, so we look at the performance of the stocks and the risks through time. It's also a point in time. What is the current price to earnings multiple, the current price to book? But it's also forward-looking information. What is the forecast earnings growth? What are analysts saying in terms of where earnings are going to be revised to? There's a lot of forward-looking data that we capture as well. But we don't do any, in this portfolio, we don't do any adjustments to the data based on our interpretation of it. So we don't do any forecasting. We are simply systematically and rationally applying the fundamental philosophy.
why is it in this day and age that the good old adage of going to kick the tires doesn't really seem to be vogue? Is there just no need, no value in doing so, going to visit management and unpacking?
So I think if you are going to go through the expense of kicking the tires, you need to really obtain some significant insight from that. And to make that worth your while, you have to put on a big bet on that insight. So you've obtained what you would pertain to be an idiosyncratic edge for a specific company. And to really make that count in your portfolio, you have to make a very big investment in that. But I'm not saying at all that there isn't a space for that. I think that is a quite a valuable approach to asset management, and it delivers an uncorrelated alpha profile to a systematic fund such as this. What we're trying to do is we try to minimize the idiosyncratic risk in the portfolio and build a well-diversified, well-blended portfolio that performs not in short, erratic cycles, but through the economic cycle of 3 to 5 years and generate consistent alpha through that period.
So what happens in the event of you do your analysis and very little sitting in best of class or in the petals? Is that a potential, and what would happen in that scenario?
No, because like I said at the beginning, the entire analysis starts by cutting the market in half by these various dimensions. So by the very definition of the mathematics, about 10% of stocks will sit in best in class, 10% will sit in worst in class, and about 10% in every petal or every block, every bucket in the diagram.
Okay, so COVID brought about the acceleration of the three letters ESG. Where does that come into your thinking? I mean, what is it? What's the value of that, if anything, for you when analyzing the market?
So in our mind, and the approach that Stanlib takes is that we don't believe in an activist approach or an exclusion approach. We believe in engaging with company management. So we've got a significant in-house ESG framework and ESG policy. And whenever we have holdings in a company and we have the opportunity to engage with management and the board, we would do so within the parameters of that ESG framework.
Okay, excellent. Well, look, Rademeyer, I think our time is up, so I'd like to thank you for sharing that insight with us. It's fascinating to see how the industry is developing, and I congratulate you on the strong levels of performance, and long may that ultimately continue as well.
Thank you, Leon. Appreciate the time.
All the best. That's Leon Kralen for EBNet Stream.